Welcome to the Trader's Edge. I'm Jim Iuorio. That's Bobby Iaccino. Thank you to Tradier for hosting us. Tradier is awesome. Also, we are 2/3 of the team at unfilteredinvestor.com, along with our chief technical strategist, Mike Arnold. Please check us out there. I don't know if you people saw the video of My Fair City where the Cubs and Sox players, we were just talking about in the green room, and I think we have to bring it out. And this is going to be a tale of caution to anyone who's not familiar with the city of Chicago. So these two big, huge, burly, hairy Cub fan guys in jerseys are talking shit to these 5 different Southsiders in Sox jerseys, okay? They're calling them bitches, and finally they throw the beer on them. And then guess what happens? The Southsiders beat the crap out of them. That's what Southsiders do. The Cub fans didn't even raise their fist. Bobby, what were your thoughts on it?
I totally agree with you. I mean, I don't know if the guys thought that their soft milk jug bodies were going to protect them from the punches from the Southsiders. I'm an unusual Cubs fan because I grew up more on the South Side than the North Side. Yeah. Right? I was south of Madison most of my life. So I fought those guys and I lost to quite a few.
Yeah, they're good at that.
I still wore like my Cubs hat to go to Sox games in Sox Park. Yes. But still, be like, Cubs suck. I'm like, we're good.
Yeah, and I'm not even saying don't fight with those guys. Just be ready. They are going to pummel you. Okay, they're coming after you. But anyway, this show, sometimes we talk about markets. I don't know if you guys know that. And today was a big deal. You saw the news from the Treasury, and you saw the results in both gold and Bitcoin, right? So the Treasury is buying the long end. Again, it's some sort of yield curve control. I guess that means they're selling more of the short end, right? But either way, there is some serious worries about the fragility of the long end. And on August 5th, I bought gold, silver. I wrote that piece for the Substack. I think it's all happening. Man, it's all happening is probably too hyperbolic, but I do think there's serious worry in the bond market. And I think we got to get our shit together soon. Bobby, thoughts on that quick before we bring the guest?
I agree. This is, again, part of the reason I liked gold better than silver at the time when you and I were talking about it.
And I bought silver because I'm an idiot. Yeah.
Right. Yeah. So look, I actually looked into this Treasury doubling of purchases quite a bit. And apparently it's part and parcel to their normal debt management, but they're doubling it up. So the first thing I looked at when I saw yields go lower, but they actually went slightly higher on the front end. So I looked at the dollar, and the dollar got pummeled today. Yep. And that's because they have to increase issuance to double down on debt management.
Bingo.
So it's either going to be printing money, which that's not what this is. This is not QE, but it might as well be. Yep. They're increasing their normal debt management load, which is going to take long end out and theoretically increase the demand for the ones that are being issued now. They're going to have to issue more. I mean, the Treasury doesn't just have money.
Yeah, of course.
They have to get it from somewhere.
Yeah, things are getting more and more serious. And again, like I always say it this way, 10 years ago, if you had asked me, I said there was about a 0.1% chance that there'd be a debt crisis in the next 15 years. I think that number's gone to about 10 to 15%, which, by the way, that is absurd that the United States has a 10 to 15% probability of a debt crisis in the next 10 to 15 years. It is the height of irresponsibility. But anyway, we could talk about this all day. I want to bring in our guest who I'm very excited about. I've never interviewed before. He is Jared Johnson. He's the co-founder of Johnson Randall, and he runs the Catalyst Plus Fund, and he's got fabulous hair. You guys are not going to believe the head of hair on this man. Let's bring in Jared Johnson. So the reason I mention it, Jared, I hosted the morning radio show on WIND Chicago this morning, and they also do it as a podcast where they have cameras and it's launched on YouTube. And they have one camera, and all the camera did was just train right on my bald spot. So I'm very hair conscious today. I interviewed Kevin Roberts from the Heritage Foundation, and I did say to him, Kevin, you're an expert on being bald, so let's talk about this. And he didn't seem to mind it that much. But you do have fabulous hair. Tell us a little bit about yourself.
Well, and let me just say, you have a decent head of hair yourself, so you have nothing to be self-conscious
about.
There's a big age difference here, guys. There's a big age difference.
It's a big age difference. Yeah, you're like 35, right?
Oh, I wish. 46, headed into 47 on a banana peel. It's,
nice.
It's
all right, he's not going bald.
Okay, you do have good hair, man. Okay, where are you coming from?
Joining from Utah today. We're just outside of Park City, Utah.
Are those real mountains in the background?
Those are real mountains right outside my office window, and those are the little guys. So we have some great skiing out here. We're just outside of a nice ski town, and so the Rocky Mountains are right here.
Yeah, I still technically have a house in the Rocky Mountains, but I've already agreed to sell it, and the final payment comes in April, and I will no longer have a house in the Rockies, which kind of bums me out a little bit because I do love the mountains. Yeah,
it's beautiful, but there's other spots.
Yep, Bobby.
Yeah, just real quick, and this is not going to be necessarily related to you, Jared, and so I apologize for that, but I want to put up a gold chart real quick if I could, because part of this is sort of for people that watch us on other shows, but I think it's important for this group as well. Luis, can you put this chart up real quick? You'll notice on the gold, this is the gold futures, and you'll notice on the daily charts that I have these retracement levels right here, right?
Yep.
This was setting up for a technical double top here, right? Here to here.
Right.
And if you broke down here, I was starting to look where the measured moves would be. And you notice that this measured move target would be somewhere around the breakout level here. So I was thinking, okay, this is an area where I'm going to buy more gold. Jimmy, Jared, I don't know if we talked about this when I did your show. I own a lot of gold, and I haven't sold any, even with the sell off from the highs. I haven't sold a stitch of gold. Now, then today happens, right? This is exactly why people should never front run their process, right? I've taught a lot of people how to trade these double patterns. We have a very specific way of looking at them, Jared, with very strict criterion. And this was fulfilling the criterion for a technically correct double top, except you had to wait for the close below this low, and boom, it never got there. This is exactly why you don't front run your process. Jared, you have a process, right? So rather than explaining what your process is, Luis, we can get rid of that chart. Rather than explaining what your process is, tell me what process means to you as a fund manager.
Well, all of my colleagues and everybody, in this industry, we love to talk about predictions, where everything's going, the future moves, right? And on my show, on my podcast, I interview a lot of people, yourself included, Bob, which was great. And everybody has really good reasons behind why they do what they do. And I've learned some amazing, prediction and setups and so on from what other people are doing. At the end of the day, these are the best guesses we have. And so what we have to do, and certainly what we try to do in my fund, is get the best prediction we can, but make sure that we have a process that gives us the probabilities that we need to win a lot. Now, that's going to mean very different things for everybody, right? There's short-term traders and long-term traders, and there's people that use options and people that don't use options. And we're kind of a combo of all of that. And so I use as much of that as I can to have those best probabilities, so that if I'm trading what I think could be a double top or, a continuation in gold high or whatever it is, that I have a process that says, okay, I can come out of this profitable, but at what cost? Or I need this to be a quick turnaround, right? And so those kind of two approaches will heavily determine how I trade the things that I trade. But I tend to lean, I just don't like win or lose scenarios. People love to talk, and people that I interview talk about, what's your win ratio? What is your success rate, and so on. And I just say, I like win-win, and we can have that. Yeah. But it comes at a little bit of a cost. And what is that cost? And is that the right approach for the person using it? And it works for me, not for everybody.
Can you give an example? And I know you don't want to give away the secret sauce, but you can give an example of a recent trade and how it worked out.
Yeah. So for example, I'll just say I'm in SpaceX, right? So we have a SpaceX position. We have a lot of positions right now, but we have a SpaceX position, and I figured SpaceX would do what it did, right? And it certainly did. It went up.
So did we at Unfiltered Investor, by the way. Yeah, exactly.
Yeah, we talked about that.
Overhyped IPOs are just that, right? Yeah. Anyway,
they some go up a little bit longer, but they all come down and they all get sub IPO price. And so what I did when SpaceX, I'm trying to remember what our high was on SpaceX, but I did a very typical thing that I do. I think we had the high, a couple days after the IPO was about 225, right?
Luis, I got a chart there if you want to put it up.
And then we'll tell you what we did after that. Yeah. Okay.
Mm-hmm.
Yeah.
Perfect. So in the case of SpaceX here, 225 is the high, about 150 ish. I said, okay, this is, and this isn't my typical. SpaceX was certainly more downtrending, and I tend to have a bullish bias on everything, right?
Mm-hmm.
With a bearish kind of element that we can talk about. But I said around 150, okay, I'm gonna put on a very simple option trade, and this is one part of my process. But around 150, I said, okay, this is where if it turns and goes bullish, I'll make some money and get out quick. If it continues down, I have time to ride this down and just take assignment of the stock. I don't just trade short puts, but it's along those lines. We do a lot of put spreads, short puts, that kind of stuff, with the full anticipation of taking shares of stocks that we want anyway. We're just giving ourselves, the opportunity to get it at lower prices. So I started the trade at 150, took assignment, ended up with shares at 125. My actual cost basis was 125, and so I've been holding it since.
So people, you watching real quick, that means he basically sold the puts at $25, right? So so your cost basis was 125. Okay, good. Yeah.
Yeah. Yep. So that's me, taking that option premium in, putting it towards the price of the stock. 125 is my cost basis, and now I'm sitting and holding, and I'll continue to sell puts because I do, I'm okay taking some more shares of it, but I'm also selling calls at higher prices to just continue bringing that cost basis down. And if the stock gets, at this point where my calls are, if the stock gets called away, I'll make, $25 or $30 a share on a decent sized position. And I am happy to do that all day long, every day. I never try to hold on to anything too long term. I want to make $15, $20, $25 a share on whatever positions I have, and then go and do the next one. And I get a lot of questions from both investors and people saying, why not let something ride? Why not let like a Micron ride up for $500 a share or whatever? And, I might be in and out of Micron 10 times on the way up, but I'm not a long-term investor. We're kind of the 2 to 6 week time frame. And we just want to have a repeatable process that gives us great probabilities and a real high win percentage.
So tell me this, when you're identifying the put to sell in this particular strategy, or anyone, if we can broaden it up. So is it something, do you pick a level that you think looks attractive, or do you look for a level that other buyers perhaps have been, just feasting on those puts and drive them a little bit higher than your model has? Like, how much do you on your valuation model, how much do you determine that versus just the level you like and want to buy it at?
It's a little bit of both. With some of these new companies, and SpaceX, we rarely do something with too new of companies, but SpaceX is, they have a long history of, Elon Musk and that whole thing. So it's a little bit of a different scenario. But in a typical case, in our strategy, most trades will start with a put spread, right? And so
selling it or buying it? Selling it, right?
Selling, I'll be short a put spread. So I'm bullish a put spread. And so I will identify levels based on both fundamental side of things, what I think the company is worth, as well as a technical side of things where I think there are buyers, where I think there is interesting support. And again, SpaceX was a little against kind of our typical strategy, because typically we want to find stocks that are already trending up, that are in some sort of pullback. And so I'll find that level that looks good both fundamentally and technically. And if I don't get that level, then I will ride my put spread till just about the end, and then still look at converting those options into shares of stock. If it makes it to the level that I've identified, then I'm looking at removing my long leg of my put spread and locking in my cost basis at that point.
Bobby?
Yeah, looking at the SpaceX chart, you can kind of see this is the way that we set it up for the subscribers to our newsletter. Here's a very clear technical double bottom. Now I'm ODing on double tops and double bottoms today, but you can see the break of this one. We waited for the break of it, and then there was target 1, target 2, target 3. My average hold time in my own trading is about 26 days. So I'm right there with you, Jared. We talked about that when I was on your show. And this type of a trade, what we're starting to do for the newsletter, and we haven't done it yet, is start naming things that we think could be good long-term holds, where we're going to tell our newsletter members, yeah, we're out of this, but we like this as a longer-term hold in case this is something you wanted to, or we're out of this. This is not going into our longer-term hold portfolio, with the idea being exactly what you said. You might be in and out of Micron, 10, 15 times in an uptrend. We're going to, and it's more about function than anything. We're just going to say, okay, this one's probably going to still go up. We'll talk to you later. Because we do know that a lot of the newsletter members, they hold on to some of our trades, and we just kind of want to be helpful in that and say, this is one that we think.
Yeah, I have XLV since you and Mike recommended it. I bought it right then, and I've only increased it on the way up. But anyway, go on. Yeah.
Yeah, XLV is the same thing here. Like a lot of my charts, I'll have these. You'll see the blue dashed line is where we got in it, right? And that one actually happened somewhere around here. I don't really remember. It's usually right around where I put the stop levels or so. So it was probably right here, right? And it's basically done this, and this is kind of what we're talking about. So in terms of your process, do you have a watch list? Do you have sectors you're looking at? Do you have a macro view that you say, okay, this particular macro view, we think tech is still getting beat up. Let's start looking at healthcare. Let's start looking at consumer defensives. How do you guys pick where you're going to get involved?
So we have a few things that we do, but having this kind of underlying option element of our trading and investing and of our process, we look at a lot of option numbers, right? Because, XLB, for example, I love material stocks. I tend to hold steel and aluminum stocks forever.
Oh, right? XLB is the healthcare, Jared. You're confusing.
Okay, yeah.
Yeah.
Oh, you said XLV.
XLV. You said
XLB.
Yeah. Right.
I thought you said XLB, and I said
yeah. I know. Yeah, that's why I stopped you. Right. Yeah.
XLV. So the healthcare, and obviously driven by this massive Moderna, 160% rally that we've seen today. But regardless, what we try to look for is, there can be excellent companies that are doing excellent things, and eventually those companies will pop, right? And very often, there's the whole element of the stock market where you want to be where not everybody is, because then when they come to that spot, your stock takes off, right? The only problem in my process with that is you can be where nobody is for a very long time until people get there. And you might have to sit for a year or 2 years.
Might as well take the theta. That's what you're going to say, right?
So we look at the theta. We want to see something that, has a decent IV rank on just the volatility side of it. Are people trading this, right? Do people want this to move? And then does the fundamental and technical picture match up as well? And I'll trade stocks that, that have inherent low volatility, but I tend to sit in those for longer and they move less. And at the end of the day, I don't have any opinion really about the kinds of companies that I trade. I trade what is moving and what has the most potential to move and what is demonstrated. This is why we call it our Catalyst Plus fund, because we need a catalyst to get into a trade. It can't just be, there has to be a really underlying reason in there. And oftentimes it's option numbers or just a sector. But if it's a hot sector that's moving, the option numbers will also reflect that. So I need those things together so that I'm not in something. I mean, for example, I sat in BABA and some of the Chinese stocks for like a year. And then they took off and they went nuts and I made a bunch of money on them. But I had this money tied up for a year. And I said, I'm just cutting those out. I'm just going where there's movement and action, and I can cycle through my process a little more quickly.
So you are making sort of theta predictions in your mind. I mean, you put on a trade in a bunch of the Chinese stocks. At what point do you say, I've just had these too long? Is there like a cost of money that you calculate, or is it just kind of a gut feeling like this isn't going anywhere within my time frame? I'm missing other opportunities.
Yeah. I don't have kind of a hard and fast rule on that, but if I am sitting in something and I start exceeding kind of my 6 week kind of maximum that I try to abide by as much as possible. If I'm starting to run past that and other things are moving and what I'm in is not moving and it's, nothing is really improving, then I will look to close early. But a big part of our process is, we do our best not to cap our upside too much by selling options and bringing in premium, but that's an important part of our process as well. We want to bring in as much money as we can while we're holding an equity position. And we do the best we can to keep that cost basis on par with current stock price. So if a stock is continuing to go down and we're buying puts and selling calls and, using various types of collars on our position, which we tend to do, and it just keeps going down, then I get pretty aggressive with the covered call side of that collar and start looking at getting those stocks called away with smaller profits. I mean, like everybody, I'll take the loss here and there, but if something is starting to have a high opportunity cost, then a really small profit or break even is great, and I'll take that.
Bobby, you or me?
Go ahead if you have something. Otherwise,
I do have some, because I want to know about your risk mitigation strategy. Because when you said SpaceX, you said sell the puts, but then you clarified and said sold the put spread. Okay, so let's say, and I trade and use options all the time. I love it. I love it. It's like trying to build a better mousetrap all the time. So let's say we have a 2008 type event where all of a sudden the stock market loses 40% of its value across the board, and the good is sold with the bad, and there are no survivors essentially. Will your put spreads, instead of selling puts, mitigate your losses, and will you then lose less than if you were just fully invested in the stock market, or do you take a lot of risk on the downside?
Absolutely. That'll absolutely mitigate the risk because I have been through 2008 and I rode through COVID and all those other, wild times in 2022 and so on. So, if the overall market is fairly, healthy and bullish, right? We'll be a little less cautious on the collar side of it, but the put spread is always that's always kind of our starting point on any position. So if the bottom does fall out of the market, we have a 40% sell off. I've positioned myself in every single trade that, I have a very manageable loss if I decide to just close a put spread in a loss, or I get assigned somewhere along the way because the market's falling off a cliff. Then, my long put is still offsetting everything. And I've got kind of that defined risk already in place. And so, in that kind of a situation, yes, I could close everything. I would take a loss, but a very, very small loss compared to what anybody that is fully invested, certainly just long-term equity positions, would take.
Jared, what's the most eye-opening thing that anyone on your podcast has said? First, tell us about the podcast a little bit, and what podcast did you get done with? And you're like, holy shit, that's pretty groundbreaking, or that's something you didn't know, or something to that effect.
There's certainly one that comes to mind, and every guest that I've had on there has had a very unique way of how they approach the market, what they look for, what's important to them. One of my earlier episodes, because we're only, the podcast is newish. I think we're 40 or 50 episodes in, and probably guest number 5 or 6 or 7 has created their own prediction market. It's a hedge fund. They've created their own prediction market, and they have this little database of people that they say, what do you think the S&P is going to do? And then based on what their network comes back with, they buy 2-day long S&P calls or puts and risk 2% of the fund. And they have an entire fund based on this. And they're great guys. I speak with them all regularly. And I thought that was pretty interesting. They kind of went in with this idea of let's create this prediction market. And they kind of ended up turning it into a fund. And they've raised $100 million on this idea. And it seems to be rolling. And
they're making money and it's working?
They've been profitable, I think, every year, the last 3 years doing it. So
that's outstanding.
Crazy. 2-day options.
2-day options, 2% risk, 2-day options. That's it. And I said, I have so many questions. I don't even know where to start. But
what's so funny is that people tend to think of options as the riskier play. And I know that things have changed over the last 6 or 7 years as so many more people understand options or are beginning to understand options. But guys like you and I, and the three of us, look at them as a way to mitigate risk. And I hope that people are beginning to understand that. What are your thoughts on that?
I mean, the option game. So in our fund and everything that I do, the only options I ever buy, ever, is the long side of a put spread or the long put side of a caller. That's it. I am never buying calls and I'm never buying puts on anything. Like you said, I want to use these to mitigate risk, and I want to use them to bring in premium and lower a cost basis situation of shares of stock that I want anyway. And so, I know, and in fact, I know another fund that only trades options. They're only long options. They're only buying calls on everything. And they have these wild swings, 100% years up, 80% years down, it's a wild ride. That one's not for me. And so I think using options as a whole trading strategy and a way to profit is very difficult in my mind. I use options to get shares of stock that I want. I use options to mitigate risk, and that's worked real well.
Let's take a quick time out. Luis, will you put the banner up? This is the part of the show where I ask the viewers a favor for us, and it'll turn out to be a favor for you as well, too. Please scan that QR code and try 3 months for free of Tradier Pro. We talked to people who've been trading options for decades, and some have been trading it for days, and they all say the same thing about Tradier Pro. It is the deal. It is the gold standard in options trading platform. Do it because you're interested in it. Do it as a favor to us. Whatever you do, just do it. And now back to the show. Bobby.
I like that version.
Thank you.
So from a perspective of the options conversation, when you're looking at options, how many of these that you find that you say, oh, I wanted to do that, but earnings are coming up? Or is that not something you think about at all?
We will use earnings as an opportunity to trade stocks that we want to trade. So
explain what you mean.
What's that?
Explain what you mean.
So for example, RKLB, Rocket Lab is, and I'm starting to sound like some space enthusiast, and just a random example out there. Hood was another one. So either of those, we put some trades on both Hood and Rocket Lab prior to earnings, saying these are stocks that we want to own. If the stock goes straight up with earnings, great. We've made 6 to 10% return on invested capital for the trade. We're out and done. If it goes down, it's stock I want to have, and I've identified the levels where I'm okay taking assignment of the stock. And so, that goes back to kind of our catalyst side of things. We want to have a reason for something to move as quickly as possible once we are in a trade.
Okay, that's interesting. But by the way, you tweeted something that kind of I think it was you who tweeted or you reposted it, where you did a thing where you talked about the best performing accounts at Schwab and what commonality they all have. That was you who tweeted this, right? Because they're mostly dead people. Yes. Now, by the way, this is really interesting. You people are watching. Most of the best performing accounts at Schwab, their one link that's the most common denominator is that they're dead. I did not stutter. Is that the people are dead. Jared, can you talk to that? So buy and hold is obviously a good thing too, right?
Buy and hold. I mean, and these are the two opposite ends, right? Of, there's the day traders and the high frequency guys that are doing a million things a day. And then there's the Warren Buffetts and or the dead people, right? That just hold forever. And obviously, it's a tough one to argue with, to not just buy and hold or just buy the S&P, buy really SPY, buy QQQ, and just forget that you own it, buy some of it every month, every week, whatever you're going to do, and just retire in 40 years on it. We're a hedge fund. We don't do that. And so on. But it is interesting. And one of my podcast guests, actually, Jim, oh my gosh, I can't even think, but he's a big one out there, but he actually brought that to my attention. And so then when I saw it floating around on X, I said, oh, I got to reshare this. But there certainly, anybody that was sitting in NVIDIA, right, or Micron, or Corning Glass, GLW, right, or any of that, gold, if you would have died and passed that on to your kids, they're loving life. They're killing it because now it's up, 1,000% or whatever. And we want to catch as many of those as possible. And again, we'll do that multiple times up, but because of the nature of our fund, we don't do that and can't do that. But that's the other strategy.
Bobby, before I pass the question to you, I want to tell you a quick story too, and I want to know if you guys have this too. So about 2 months ago, a buddy of mine, Eric, who I'm friends with, but we don't see each other socially, said, "Hey, can I buy you dinner on Thursday?" So I say, "Sure," because he wants to talk to me about something. He's diagnosed with some heart condition. He goes, "So here's the deal. If I die, will you agree to immediately come to my house? My wife will have all the access codes and work out of all my options positions." And he goes, "Do you think this is a weird conversation?" I said, "Not only do I not think it's weird, I have my guy, Alex Manzera, who's already agreed to do it for me. So it's been in place for years." Do you have a guy for your personal positions, not your fund, but do you have personal options positions that someone's going to come in if you die in an accident and work their way out of?
So as it turns out, and maybe this is a bad strategy, but all of my personal funds are also in my fund.
Oh, so you have partners who will take care of it, right?
So I'm covered there. I figure I better not have anything on the side because one of the two is going to get ignored. So
good point, Bobby.
Yeah, it's funny because I only do like sort of, I don't want to say buy and hold stocks. I trade stocks I don't mind holding. Now, this goes against everything that I think, right? One of the things I find funny, and part of the reason we're going to do a long-term hold page in the newsletter, haven't done it yet, just for anybody who's interested, we haven't done it yet, is because I think a lot of the times people take a trade and then it goes against them. And then they go, well, I like the stock anyway, so I'm just going to keep it, which really what that is them just saying, well, I was wrong, but I wanted it anyway. They don't want to be wrong.
Yeah.
You know what I mean? They don't want to cut out of the speculative position. Everything that I trade, I don't mind holding. And it's for this exact reason. I'm dramatically older than my wife. That's not like an Italian finance guy at all. And so at some point, something's going to happen. And she's going to be like, oh, shit, 20 years ago, my dead husband bought this stock and I've got a lot more money than I thought I did. I'm not even telling her where they are. I'm just going to leave them. At some point, somebody's going to tell her, do you think he owns anything? Open his computer.
Yeah.
What's his password? Dang it.
Exactly.
You can figure out my password probably pretty easily. Yeah. Yeah.
I wanted to ask you about like the climate in Utah for businesses. First of all, is your fund domiciled in Utah?
It's a typical Delaware fund.
Yeah.
And our fund manager is based out of Utah.
But you still have to deal with Utah politics or sort of the state of Utah regulations for doing business there.
Yep.
Do you agree with Mike Lee to sell federal lands? Is that something that you agree with?
I see, I'm the wrong guy to ask that because, I love open land, but I also have like 50 kids and I just can't pay attention to anything but the stock market and like the next little league game that's happening. So I just don't even know. But Utah's a great place to do business. I'm a California guy. I moved here about 7 years ago. California is a terrible place to do business. There's a lot of money and a lot of people there, but everything else is terrible. And
I lived in California for 4.5 years. It's difficult to get wealthy there. It's wonderful if you're already wealthy.
It's great if you are, but I mean, the taxes and the fees and the regulations and the rules and so on. I mean, just as an example, if you have a simple LLC that you are renting out lawnmowers, it's like $1,500 a year to renew your LLC in California. And in Utah, it's $40 a year, right? And so, that's just the overwhelming kind of difference in doing business here versus there. And Utah, I've been in and out of Utah a bit over the years. My wife's from here, which is why we ended up here. So marry somebody from Hawaii if you can help it. But we ended up here. It's a great state. And, all the big tech companies kind of got wind of this 10 or so years ago. And so there's this area they call Silicon Slopes now instead of Silicon Valley. And you've got all the, Metas over there and Oracle's over there and Adobe's over there and everyone. So they're moving lots and lots of their operation to Utah, a lot more friendly tax and regulation side of things. And
everybody is literally doing everything they can to get out of California. It's unbelievable.
Yeah, and California has every geographical advantage over every place in the world, not just the United States. I mean, literally, it has everything. It has mountains, it has beaches, it has vineyards. It's the fact that they've messed this up is just mind-blowing to me. And again, they could have had higher taxes and higher regulations than every other state in the country and would not have done harm to themselves because of those advantages, but they've gotten to a point where they are. And now they're going to rely on the federal government bailing them out. Much like Illinois, and Illinois has no geographical advantages. They just had a history of Chicago being the Midwest engine. There's my rant. I want to get back to your fund real quick. Can you tell me about the average investor in your fund? Can you describe them? What are they looking for? What kind of, again, if you want to give whatever amount of details you're comfortable giving, like what the downstroke is, if a person gives you $1 million, is that person generally have 20 million investable? Do you want to go into those? Because I'm very interested if you're willing to talk about it.
Sure. Yeah, I would say that many of our fund investors, we have a few RIAs and family offices in there, but it's a lot of high net worth individuals that, and many of them, this is their first or second, run with a hedge fund. And a lot of people have had their money in real estate and elsewhere. And this is their first kind of actively managed hedge fund, which is a little bit, my personality leans towards the type of strategy that I have, but I also set up this fund so that those kinds of people that are kind of having a first run at it, money isn't tied up. You want to pull half your money out every month for 2 months, whatever, go ahead. It's liquid on a 30-day basis. Everything is shorter term, low volatility, and have a good first attempt at a hedge fund. So a lot of high net worth folk, a lot of, business owners, kind of mid-sized business owners. Average investment is in the $500 to $1 million range. A few bigger, a few smaller. We'll take 250,000. So yeah, they're mostly individuals.
And it's not non-correlated. It's correlated with a bull market, correct? Yeah. So it's definitely that. Bobby?
So what's your what are you targeting for outperformance? Are you targeting protection to the downside? Are you targeting we get in the good stocks earlier? What's sort of I don't want to hear your pitch, but what's your pitch?
The pitch is we show up to practice every day. And sometimes we're going to hit a home run just by nature. And most of the time we're going to hit base hits over and over again. Last year, the fund, we did 40%. The year before, we did 25%. This year, we're sitting at about 10%. It's not been, a gangbuster year for us in the fund, but it's been okay. And we're just
but that's what the S&P's done essentially too. S&P's up 12, and you're more protected on the downside than just being long the S&P. So that's a great year in my opinion. I didn't mean to interrupt you. You go on. Yeah.
No, absolutely. And we do kind of benchmark ourselves with the S&P. We're always trying to beat the S&P, and we always want to have about half the drawdown is what the S&P has. And we've been able to accomplish that in most kind of drawdown situations, whether it was liquidation day or, first part of this year. We have about half the drawdown as the S&P.
I love that. And again, sometimes I talk to guys like you and I'm like, I could, again, I'm not going to do it. I'm not saying it could do as well as you, but doing that, selling put spreads of stocks you want, I think is an excellent idea. And I know most people don't sit in front of a computer looking at options all day. That's why they have to invest with you. But I'm just talking, I do happen to sit in front of computers looking at options all day. Bobby?
Yeah, this is the thing that I always want to talk to people about, because people will say, just give an average, what you said right there, I don't know, would it be fair to say over those 3 years, compounded returns would be about 21% over those three, somewhere in that range, 19 to 21. The NASDAQ's like 18.9 when you reinvest dividends over the last 10, right? And like we said earlier in the show, people are always like, why don't I just buy and hold? But the difference is when I had my fund of funds, I was there for 10 years. We literally would tell people, if you brought in a sheet, the typical performance sheet you get from a hedge fund, right? The one pager. And we used to get dozens of these things because we were a fund of funds. And I said, if you brought the S&P in here, I'd throw you out, because it was like, 12, 13% a year. And then every 8 to 10 years, it lost 50, 60%, which is just insane. And if you're a retirement person, you're thinking, that's why the downside, ever since that experience, I'm like, the downside matters so much more to me than the upside does, because I'm looking at it and going, well, I knew somebody who had about $4.5 million. He was targeting retirement for about 2010. Well, that blew.
Yeah.
Right. Because he
Is
lost
this
so
part of
much
your
money in the
age
great
too,
financial
Bobby?
crisis.
Are you and I more cautious and more worried about the downside because we've gone past 60?
I think so. And I think it also is what we talked about in our show on Monday, Jim, with Luke Groman, where we've experienced long-term bear markets. If again, Sherry, do you look over the last 10 years, we've had 3 bear markets. Do you even feel them? They were just so short. And again, I'm going by the technical definition of a bear market, 20% lower or more. They literally, like the longest one was, I think, 11 months. Well, we've lived through, 2000, Jimmy. It was freaking like, what was it, 8 years or 6 years before it actually recovered, if you counted from 1999?
Yeah.
It was brutal. So I'm not sure. And we talked about this, Jared. I'd be interested in your opinion. Is there ever going to be a bear market like that again? Or has enough people learned that if you look at the equity markets and you scrunch it down tight enough, it's always like this?
It's an interesting one, because I think the real question is going to be, when do the markets stop reacting to government intervention, right? Because when you have like the .com, which was right at the very beginning of my trading career, I started right in like 2001, and things were, they were heading south. When you look at that whole .com sell-off, that was ugly, and that stayed down for, that was a couple of years of pain, right? And the government didn't really do much in the way of intervention there, right? But then when we get another big, ugly 2008, which I was up to my eyeballs in the market by then, that was the government really saying, hey, we've got to jump in and do something, or else we're going to have another 2000, and we can't have the market be down for 2 or 3 or 4 years again, right? It's too fresh in our memory. We gotta do something about this. And so then every dip that we've had, there's this, whether they admit it or not, there's the Fed put, right? And it's always there in case things get too crazy. COVID obviously was this really unknown. We didn't know how it was going to go, what it was really going to mean. And we saw how quickly that reversed. And we've seen how quickly, the most painful thing I think that we've seen was, 2022 of the Fed saying, hey, maybe we're not going to have the Fed put, and we're going to raise rates real aggressively. And it was still about 10 months of down, 11 months, whatever, of downward markets, Fed caused, right? But if it's not Fed caused, then I think everybody is counting on that to be the rescue plan, right? And until the markets stop caring about that, or until there's no more, legitimacy to the Fed's claims or the government's claims, then I think our bear markets are going to be kind of a version of what we've seen for the last 10 years. These quick sell-offs, these painful sell-offs, and these fairly quick recoveries.
So, Bobby, can I answer that question too? Because I think there's an element to it that I want you to get your guys' opinions on too, is that the bear markets of the past, like, many people wouldn't even be aware of them for like 2 or 3 days until you check your portfolio in the mail. Like and now, and yes, we laugh about it, but it's true. And now everybody checks it every day, and everybody can sell out at the push of a button. So it's not really that unreasonable to think that everything will be condensed by an amazing amount, probably 1/10 of the time frame it used to take to wash everybody out who all the weak hands, to wash them all out. Does that make sense?
Yeah, since you said that on Monday, I've been thinking about it since then, and I pretty much
said that on Monday.
Right.
I'm getting senile. I can't remember saying. I thought I made it up.
No,
right
you did
now.
say it. No, you did say it. You said everybody can just get in and then get out when it's calm.
Yeah, and you can't do that with housing, and that's why 2008 was such a different animal. You can't do that with your housing. That's why it lasted such a long and painful time, is because you can't hit a button and liquidate your home. I want to switch over to the AI theme, because you talked about all kinds of rockets. You seem like you're really, no, I'm just kidding.
Love a rocket.
Now let's go to AI. Do you think that trade is played out, or are they still on your radar for opportunities?
It's a tough one, because mostly because I think every trade is an AI trade at this point.
Amen.
I think every
I'm in healthcare, by the way. That's why I loaded up on healthcare, was the AI theme. I sorry I cut you off. I just was excited about that.
No. I mean, I think it's such a good point. I have friends that are doctors that have been talking about how the medical industry has been using AI for a couple of years, and now how it's kicked up so much. I think AI touches every industry so aggressively. I think it can do so much for every single industry, and I don't think that adoption is fast and swift right now. And I don't think we've seen really what AI is going to be able to do yet. Right. And it's moving so quickly. So I think the AI trade is everywhere. And unless we find out that AI, but I think it's already shown its value, and there's only so much more to go. I mean, not that there's only so much more to go. There is so much more to go. And so I just think, I haven't honestly been trading too much in the way of the memory stocks or the NVIDIAs or whatever. I mean, I've traded the movements and I've followed the volatility a bit, but I'm trading other things that I think will benefit from AI. And I think healthcare is a great example of that.
Bobby, I want you to have the next question, but also, AI related, I think it's impressive as hell. And your hologram that you're using for this show looks almost real. The only reason I know you're AI right now is because the hair is too perfect and the smile's too perfect. Bobby, you know.
The last thing I really wanted to ask you, Jared, was about your podcast. So what's the name of it? How often does it come out? What's your ideal type of guest? How long is the show? I mean, I was on it, but I want you to explain it.
Yeah, and I appreciate you being on. You were awesome.
And Jim will come on, I'm sure, next.
Yeah, heck yeah, I'm counting on it.
Appreciate it.
It's the Stock Market Playbook, and the whole reason, there's two reasons that I did this podcast. Number one, my marketing guys for the hedge fund said you got to do a podcast, and I said okay, I'll do a podcast. And number two, I love connecting with traders, and I love finding out what other people are doing. I love hearing about other people's processes. It only makes me better. It only makes me more aware. Even if I don't do the thing that somebody says is the golden rule of trading, I at least know about it. And I start to pay attention to all these things. And so it's really just been a great opportunity to showcase what awesome traders and fund managers out there are doing and kind of how they approach the market. And I don't talk about myself at all on the fund or on the podcast. I don't talk about my fund much. I just really try to highlight whoever the guest is on there and whatever their process is. And I just want to kind of raise awareness for everybody, what people are doing, how they're approaching it, how the short-term trader is killing it, the long-term trader is killing it, the mid-term trader is killing it, and how people can kind of, improve their approach.
It's one of the great things about the space that we're in, Jimmy, is we're not competing with each other.
Oh, no doubt.
Like literally in the podcast space and the shows like this, no one's competing. We're just like, hey, you guys should check out this show. You guys should check out that show. And I think you should check out Jared's show. I
do too. One of the things I love that the both podcasts we have gotten good traction, but I'm in it. I want to grind legacy media into the dust. I despise them. They are my enemy, and I will keep doing this because our product is a shit ton better because we don't have producers chirping in our ear saying, oh no, you got to be positive SpaceX now. No, I got to be what I am SpaceX. I don't have to make a bull case for SpaceX if I don't feel like it. And people want honesty. I think 2020 was just a great time for people like us who want to get out and just say our honest opinion and not have it be shrouded by sponsors and producers. I hate myself for not asking this question before, but I have a internal, like a machination question about the fund before I go. And Bobby, you're going to kill me for this because this is bad podcasting. But
I thought it was going to be the hair when you.
No, it's about taxation. It's about, so if someone invests in your fund, because I may at some point give you some money, do you pay, is regular income, is that when you're getting option premium? How does the investor, is it hurt a lot from taxation standpoint?
We have a great CFO that does an amazing job at explaining this better to people, but the type of fund that we have, people are getting long-term and short-term capital gain type taxes.
Right. Yeah.
So,
and there's no way to avoid that, right? Yeah.
We do have a Cayman feeder, and if you happen to be a charity or something similar, then we'll take that too. So that's a good way around it. But yeah, the taxation side of it, and we've talked about different strategies related to trading futures markets with our strategy and getting some better tax treatment there. We do what we do, kind of a thing.
No, and again, if you're paying a decent amount of taxes, you made a decent amount of money. So I understand. I didn't even mean to bring that question at the end. It was just something that was kind of burning in my head, and I apologize for that. Bobby, should I play us out?
Yeah, I just want to let you guys know that Bill Gates' daughter took a secret class at Harvard on how to run the world.
No, I know that. Yeah. By the way, my daughter, she was an undergrad when my daughter was graduating from grad school. So the same graduating class from Stanford. So Melinda Gates was the speaker at it. And, everybody there knew who Phoebe Gates was, which
she literally looks like a supervillain in a Marvel movie.
Yeah, I know. And she's facing up to 20 years for whatever some scheme was, whatever. It's amazing to me. But anyway, he is Jared Johnson. What's the name of your fund again? Tell them where they can find you.
You can, I'm Jared J. Johnson on X. We're johnsonrandall.com, the Catalyst Plus Fund. Those are all the same. My LinkedIn and my YouTube as well is Jared J. Johnson. So
did you and Randall have any sort of fight as to whose name would be first, or was it?
It was a very tough discussion. And I looked at Randall Johnson, not available. Johnson Randall, available.
Bingo. Then
discussion over.
Right. Because everything Bobby and I do is called Iuorio Iaccino, and that's in my contract.
Actually, we don't name anything after ourselves because Iuorio Iaccino and Iaccino Iuorio sounds ridiculous.
Well, it sounds like we're a couple of mobsters too, who are about to break your kneecaps.
Really sounds like an olive
30
oil
years
brand.
ago. Yeah. Right. Anyway, let's stop this nonsense where it is. This has been The Trader's Edge. I'm Jim Iuorio. That's Bobby Iaccino. Thank you guys for joining us. And please check us out at unfilteredinvestor.com and check out Jared at his hedge fund too. Thank you guys for joining us.
Thanks for having me.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.